I do think that the deadline will be met. And there was certainly a lot of drama in D.C. last week. And I think that the budget charade, for lack of a better word, will end this week due to the fact that politics is all about political interest and survival. And to that point, the president is not up for election again anytime soon, and the senators and congressmen are up for re-election. So I think it's pretty easy to see who wins that game of chicken. And the budget deficit is collapsing at a much faster rate now than even the nonpartisan Congressional Budget Office has even suggested. What that does is reduces support for tax increases and spending cuts. Now, the Republicans have stopped bargaining their budgetary votes away in exchange for tax and spending cuts, and I think trying to eliminate funding for Obamacare was really a flawed strategy in my opinion. So I think the budget charade will end this week or next weekend at the latest. And Bill Gross, who's the manager of the world's largest bond fund, it's been reported this week that he's buying bonds. Now, I think he senses that this is all a lot of drama, and in the end, there will be no default. I think he feels a deal will be done and the debt ceiling raised. And as we all know, the debt can will probably be kicked down the road once again. And even Warren Buffett put it this way this week. He said, "We'll go right up to the point of extreme idiocy, but we won't cross it." And even the finance minister of China warned this week that, quote, "the clock is ticking," and to avoid a default that could hurt Chinese interests. And when you think about it, I think we can think of about 1.3 trillion reasons why that they're certainly worried about a default happening. So here we wait for a 11th hour solution. Do we run the risk of even coming up empty-handed, and would this lead to a scenario that would be ugly? Well, it could be, but I doubt that would happen. But this is a scenario, in summary, I think, that we do have to face one day, because we have certainly kicked the can down the road so many times without any solutions. And the only solutions that we've had have been raising taxes and allowing the dollar to depreciate. So I think that we're going to end this all within the next 7 to 10 days. Gold is trading sideways, I think, for several opinions, and I'm going to preface my answer to your question with the following. Ben Bernanke, who holds economic degrees from Harvard and MIT, and he's also led the Federal Reserve through the largest financial disaster since the Great Depression. He told the Senate Banking Committee in July, quote, "Nobody understands gold prices, and I don't pretend to really understand them either," end quote. Well, now that one of the smartest men in the world cannot probably answer your question, I'm going to try and do my best to answer it. Now, a little bit of history. Gold has risen sixfold for 12 straight years through 2012. But for this year is the first year that it's been down, and it's down about 22%. Going back to Congress, Bernanke told them that investors see what he calls a reduced need for, quote, disaster insurance, end quote. Now, gold has risen about 70% from the financial crisis bottom around December 2008. And it rose that 70% from 2008 to June of 2011. And it did that as the Fed debased the dollar by pumping really more than $2 trillion into the financial system. Now, what that did was spur demand for a hedge against inflation. People bought gold. Well, that protection seems not to have been needed because the U.S. consumer prices have risen at an average rate of only 1.7% for the last 5 years. Of course, we have to remember that those are the government's numbers for inflation and not actually what we all see in a day-to-day living. The most accurate gold analysts on Wall Street are saying right now that the gold bear market is going to deepen. Goldman Sachs has one of the best precious metal analyst on Wall Street, and he said gold should drop to about $1,100 within 12 months. Well, right now we're at around $1,320. In fact, I saw this morning that at a precious metal conference in London that same Goldman analyst said gold is a slam dunk sell. I thought that was interesting. Now, central banks worldwide started buying gold in 2008 as policymakers certainly felt like that, or as policymakers, I should say, lowered interest rates to record low levels, if we remember. And as the European central banks believed that the euro would cease to exist during the European crisis, those European central banks bought gold instead of holding euros, and they certainly did not want to increase any holdings they had of U.S. dollars, so that helped push gold up. So fear and desperation drove the demand for gold for the last 5 years. Now, what's interesting is that there's been concentrated selling of gold this year. If you look at the gold ETF, GLD is the symbol, we've had 5 straight weeks of outflows in GLD. In fact, over 15 tons of gold was sold from the ETF in August. And right now that ETF is at a 4.5-year low for holdings of physical gold. So in summary, it all boils down to supply and demand, inflation expectations, and also the future direction of the dollar. Now, Sir John Templeton always told me to remember that a declining dollar is bullish for gold. Well, gold, as we can see, is certainly being pulled in both directions now, and it seems to be going in a sideways movement. So technically, the outlook is a little bit bearish right now, but that could turn bullish if we can find gold exceeding its 50-day moving average at around 1350. So we may see some sideways movement for a little bit longer here. Institutional program trading, I think, can also be called high-frequency trading, and it certainly has had an impact on the financial markets. And maybe I should define a little bit about what high-frequency trading is. I'm certain a lot of people out there really could probably not adequately describe it. And high-frequency trading is nothing more than a type of algorithm trading that uses very sophisticated technological tools and computer algorithms to rapidly trade thousands and thousands of shares of stock at a time. Now, the computer programs are proprietary to each firm out there that does this, and they can move in and out of stocks in seconds or fractions of seconds. And high-frequency trading firms actually make up about 55% of all trading that we see on the exchanges in the United States and even worldwide. Now, what they do is that they try to capture a fraction of a cent on every trade they make. They don't use leverage, as many people think that they would, and they don't accumulate positions, or they do not even hold these positions overnight. It's just rapid trading in and out of stocks. Now, like anything, there is good and there is bad with high-frequency trading. Now, high-frequency trading firms say that they add a lot of volume and liquidity to the markets. And this is true for the very large volume, large cap stocks that you would find in the Dow or the S&P 500 or the NASDAQ. So it does make the market more efficient and less risky. Now, high-frequency trading is regulated by FINRA, and it's also regulated by the SEC. So even the bid and offer spreads that you see in stocks, they're much, much tighter today than when I started in the business 30 years ago, and this benefits the smaller investor who may buy 100 shares of Exxon, let's say. Now, a big negative is the volatility that high-frequency trading can cause when their algorithms from their computer trading programs go bad. And I think we can all remember one of the best examples of this, which was the flash crash of May 2010. If you remember, the market fell more than 10% within just a moment or two. It's less than even a minute. I can remember watching the computer screen that day and wondering why stocks were falling 10, 20, and 30% in just seconds. So that was an example of high-frequency trading where the computer trading and the algorithms went bad. It did not last more than a couple of minutes, but it did cause a lot of consternation. So in summary, if stock buyers and mutual fund investors, if they're long-term in what they're doing, high-frequency trading is really not even a factor to them in any way, shape, or form. And in reality, the structure of trading in the markets has changed so dramatically over the years with the advent of computers and with the ability for them to trade in really milliseconds or even microseconds. So in summary, the impact has been, I think, on the whole, been very positive for the markets. For Money in Markets, this is Douglas Davenport. Thank you.